My friends, the air in the crypto market is thick with fear. Just when we thought we'd weathered the storm, a new, far more insidious threat has emerged, shaking the very foundation of global finance. I'm talking about a geopolitical earthquake that sent shockwaves through every asset class, from traditional stocks to the volatile realm of digital currencies. And Bitcoin? It just plunged below the unthinkable $100,000 mark. But the real story, the one that should have every Cardano holder on high alert, is the devastating ripple effect we're seeing right now with ADA. Last week, we witnessed a brutal 15% drop in Cardano's price, dragging it down to a precarious 54 cents. It wasn't just a dip, it was a cascade, fueled by escalating tensions in the Middle East after a targeted attack on Iran. This wasn't some minor geopolitical tremor, folks. This was a full-blown military strike, directly impacting global sentiment and igniting a massive wave of fear. And here's the kicker. This double-digit correction triggered a wipeout, a brutal $17 million in long positions liquidated in less than a week. The charts tell one story, but the on-chain data? That, my friends, is revealing a far more sinister plot, a pattern of profit-taking and dormant whale activity that screams selling pressure louder than any news headline. Are we at the precipice of something far worse for Cardano? Let's unravel this. So, what exactly happened? Late Saturday, the world woke up to the news. The U.S. attacked 3 nuclear facilities in Iran. This wasn't just a headline, it was a geopolitical grenade thrown into an already tense global landscape. President Donald Trump's announcement sent a clear message. The conflict between Iran and Israel, which had been simmering for over a week, was now escalating, pulling in major global powers. Now, you might be asking, what does a military strike in the Middle East have to do with my digital assets? Everything, my friends. This kind of event triggers what we call risk-off sentiment in the global markets. What does that mean? It means investors, big institutions, and even individual traders suddenly get scared. They pull their money out of risky assets, things like stocks, emerging market investments, and, yes, even cryptocurrencies, and flock to perceived safe havens like the US dollar, gold, or government bonds. We saw this play out in real time. Bitcoin, the king of crypto, plummeted to $98,200 on Sunday, a level many thought was untouchable. And Cardano? It followed suit, hitting levels we haven't seen since early February. This wasn't just a correlation, it was a direct consequence of a market gripped by fear. And the clearest evidence of this panic? The liquidation cascade. If you've been in crypto for any length of time, you know the term liquidation sends shivers down your spine. For those new to the game, imagine you've borrowed money to buy more crypto, betting the price will go up. When the price crashes unexpectedly, the exchange automatically sells your holdings to cover that loan, leading to massive, forced selling pressure. And according to CoinGlass data, Cardano saw nearly $17 million in long positions wiped out in just 1 week. That's $17 million that investors bet would go up, now being forcibly sold into the market, adding fuel to the fire sale. This isn't just retail panic. This is a systemic shock. But wait, it gets even more concerning when we look under the hood at the on-chain data. Beyond the immediate market reaction, the true story of Cardano's vulnerability is being written directly on its blockchain. This is where we separate the FUD from the fact, using advanced on-chain metrics that show us exactly what the big players, the whales, the long-term holders, are doing. And what they're doing right now, it's not bullish. Let's look at Sandeman's network realized profit/loss, or NPL. Think of NPL as a thermometer for profit-taking. When this metric spikes, it means that, on average, ADA holders are selling their tokens at a significant profit. They're locking in gains, and guess what that does? It floods the market with supply, increasing selling pressure. As you can see on this chart, we saw a massive spike in NPL on June 16th, reaching its highest level since early March. And then, a similar, though slightly smaller, spike just this past Friday. This isn't just random selling. This indicates strategic profit-taking by holders who have been sitting on substantial gains. They're cashing out, and their exits are contributing directly to ADA's current weakness. But it gets deeper. Next, we have the Age Consumed Index. This is a fascinating metric because it tracks the movement of dormant tokens, coins that have been sitting idle in wallets for a long time, sometimes years. When you see big spikes in age consumed, it means these long-held tokens are suddenly being moved. Why is this important? Because historically, these spikes often precede a significant price decline. It suggests that long-term holders, the diamond hands if you will, are suddenly moving their ADA, often from their personal wallets to exchanges, precisely to sell. They're waking up from their slumber. The most recent uptick in age consumed on Friday was a chilling premonition, forecasting that ADA was about to face even more downside pressure. It's a classic bearish signal, indicating a potential shift in long-term holder sentiment. Now, let's marry this on-chain behavior with the technical analysis. Cardano's price action has been textbook bearish. On June 11th, ADA tried to break above its crucial 200-day exponential moving average, a key indicator for long-term trend, and it was rejected. Hard. What followed? A brutal 25% crash in just 11 days, taking it down to 51 cents on Sunday, the lowest levels we've seen since early February. To make matters worse, ADA also closed below a critical ascending trend line last week, a trend line formed by connecting multiple lows since early November. Breaking below this line is a significant bearish confirmation, signaling a shift from an uptrend to a downtrend. As I speak, ADA is hovering precariously at 54 cents. The technical picture, combined with the on-chain data, paints a grim outlook. If ADA fails to hold its weekly support at 49 cents and closes below it on a daily basis, we could see an accelerated decline, with the next major daily support all the way down at 45 cents. This isn't just a prediction, it's what the charts are screaming based on historical patterns and current momentum. So, is it all doom and gloom for Cardano? Are we headed for a complete collapse? Not so fast. Even in the darkest moments, the market often presents intriguing countersignals, whispers of potential reversal that savvy traders watch for. And right now, there's one major technical indicator screaming for attention, the Relative Strength Index, or RSI. As of this moment, Cardano's daily RSI is reading at a staggering 26. For those of you who track technicals, you know what that means, an extremely oversold condition. When an asset's RSI drops below 30, it indicates that the selling has been so intense, so rapid, that the asset is now considered oversold, making a short-term bounce or recovery more likely. This is where the contrarian investors start to pay attention. After such a brutal sell-off, the chances of at least a temporary recovery are high, as the market often corrects its excesses. However, and this is a critical however, we cannot ignore the other major technical signal, the Moving Average Convergence Divergence, or MACD. The daily MACD for ADA is showing a clear bearish crossover, where the MACD line crosses below the signal line. What's more, it's displaying a rapidly rising red histogram bar below its neutral level. This indicates strong and increasing bearish momentum, suggesting that despite the oversold RSI, the underlying selling pressure is still very much in control and could continue driving the price lower. So, we have a fascinating and incredibly tense battle playing out here. On one side, the RSI signals extreme oversold conditions, hinting at a potential bounce. On the other, the MACD is shouting about relentless bearish strength and momentum. This puts Cardano at a critical juncture. Can the oversold bounce materialize and defy the powerful bearish trend? Can ADA recover and extend its climb back towards that previously broken trend line, which now acts as resistance, around the 60 cents mark? Or will the overwhelming geopolitical fear, combined with the persistent on-chain selling pressure and technical bearish momentum, push ADA further down, perhaps breaking that $0.49 support and cascading towards 45 cents, or even lower? The next few days will be absolutely crucial. This isn't just about Cardano. It's a microcosm of the entire crypto market grappling with unprecedented global instability. The market is a battleground, and only the most informed, the most vigilant, will navigate these treacherous waters. My advice? Stay informed, watch these key levels, and remember, in times of extreme volatility, capital preservation is paramount. This isn't the time for reckless bets. And remember this, my friends, this is not financial advice. The cryptocurrency market is incredibly volatile, and every investment carries significant risk, including the potential loss of your entire principal. Always do your own thorough research and consult with a qualified financial advisor before making any investment decisions. I'm here to provide analysis and insights, but your financial future is in your hands. Stay safe out there, stay sharp, and I'll see you in the next update as we track this unfolding drama. The crypto journey continues, and it's going to be wild.